Mark Matthews and chat about what his reading of the market is. Mark, hi, morning. Can't help but talk about what's going on between US and China. Are we back to square one after all that optical illusion of a truce?
I don't know. I think we just have to wait until Friday. If on Friday there's a deal, the markets will recover, and if there's not, then they're going to go down. But from what I can read, it seems like China had backpedaled, that's the way the Americans are putting it, on several things they'd already agreed to. And the reason seems to be that they felt after the success of out of China after that. I don't know. I don't think anybody really knows. But all I can say is we'll have to wait until Friday to know what's going to happen.
Mark, there seems to be a sugar rush which global bulls seems to be enjoying. It could be linked to the general liquidity environment. It could be linked to the fact that there is a smart rally in the bond market, or this purely could be market repositioning after a poor 2018. Whatever may be the underlying factor, Mark, the bottom line here is that if you're buying stocks, if you're participating, if you are going home with long positions, you are making money. So do you think this carnival feeling will continue irrespective of what's going on in the world?
You know, I think it depends on two things. And the first is related to what you said in the beginning, the liquidity rush, which is still very much in place with low interest rates and low bond yields as a result of the Federal Reserve and then subsequently the ECB and the BOJ and all the other central banks of the world becoming more dovish. That's point number one. And that, I think, will probably remain the case, as much as Jerome Powell said that his inflation is transitory. I don't think inflation is going to come back up very, very fast in the second half of this year. Could be wrong. But anyway, I don't think the Fed will be raising rates. At least they'll be keeping them stable. And that's supportive for equity prices, because if rates stay low, what else are you going to do with your money? You get hardly nothing in the bank these days. Now, the second thing is the trade war. And as I said, I wish I could tell you what I think the outcome is going to be of that. It's certainly in both sides' interests to find a solution. But from what I can read, there actually seem to be many things they disagree on. So if they're unable to, build a bridge, then I think we could be looking at no trade deal on Friday, and that would take the market lower.
Mark, can you still, give us a sense as to what the outlook is on the overall election outcome? Do you believe that to take a real call on the Indian markets, you would wait for the outcome, and that if we do see the BJP forming a majority, that, the gush of flows, the market momentum will generally be fairly strong?
Basically, to make a short answer, yes, I think so. I think everything that you said is accurate. I think that if the opposition wins, the market will go down because it will be perceived to be an ineffective government. Whether that's the case or not, I'm not sure, but that's certainly the way that it's being presented. And then if the BJP can get enough votes to over the 272 threshold on their own, of course, that's fantastic. And if they need to bring in more coalition partners, then that dilutes a little bit their ability to reform. But I still think the market would like that result as well.
Some would argue that why should market get excited if the current administration comes back into power? I'm taking a very critical view here, but perhaps a realistic view, which is that in last 5 years, the BJP or the NDA administration has not really managed to achieve something extraordinary. Earnings in India are still languishing. Demonetization has not really given its due benefit, and GST implementation is still struggling. So if we are in more of same for what has happened in last 5 years, I guess that's bad news for Indian markets.
Well, I think one can make the case they've done a lot of good, and the implementation of these major structural changes is the hard part. The execution is the hard part, and it takes time. And the other point I would make is that often what is good for the economy is not necessarily good for the stock market, or at least the stock market doesn't react in the same way. So some of the things you mentioned, like demonetization and GST, of course, I think most people are not in favor of those things, and it didn't help the stock market. But if you take a long-term view, I think it's difficult to argue that they were bad for or are bad for the Indian economy. It's just these are deep structural changes that actually need to be done slowly, because if you do them too quickly, you can cause real social problems. So I would actually step up and defend the government's track record. I think it's been excellent, but the kind of reforms they're trying to implement have to be done slowly and carefully, because these are extremely large changes to the way the country's run.
The side of the question, which is that if there is indeed a change of administration, and if Indian markets fall because of that 5%, 10%, I'm not getting there, but if they fall because of the event outcome, will you be a buyer in Indian stocks?
Yes, basically, I think that it depends on the magnitude of the fall, of course. 5% or 10% would probably not be enough, but below 10%, it might start to get interesting, because as much as the government is important, and it is, what India has is still that enormous domestic economy, young and large population, which I can only think of one other country in the world that has the same dynamic, which is Brazil, which has a market that's as investable as India's. The other ones that have that kind of dynamic, you can't really put much money into them, like a Philippines or a Pakistan. So yes, I would say that if it slips a lot, that would be an opportunity to buy on the event, in the event of the government losing this election.
Mark, just wanted to get your perspective on Indian financials. I know this is the most favored of the lot, but that is exactly the problem, that just everyone on the street is extremely bullish, and within financials as well, they're only concentrated pockets. Private banks, within private banks, also corporate banks. I guess one victim was ICICI Bank, great numbers, but the fact that just the entire street is bullish on it has completely failed to impress the stock prices this morning. Is that a worry as well? That expectations are too high and scope of disappointment is higher when it comes to Indian financials?
No, I don't think so. I mean, with Indian financials, of course, you've got two broad camps. You've got the state banks and then the private banks. And the state banks, I think, we're clearly seeing a recovery. You could see that in the earnings of SBI a few months ago, and now we're getting, I think, what shows us as NPAs coming toward over at least over the hill with the NPA resolution. And I was very happy last week when Yes Bank took a very big tumble on the back of the massive write-off. They announced that the whole sector basically didn't perform. It stayed very robust. So I think investors are differentiating, and I think investors are realizing that there are good banks and bad banks, and I think the key thing with the entire sector is the NPAs. We seem to be over the worst of those, and therefore the provisioning, particularly in the public banks, should slow down in the years ahead. And those are the ones whose share prices are still so far below their previous highs.
Bank, as expected, is reacting to good set of numbers. Mark, you are in the business of allocating money. You don't have any favorites here. So if you really have to park your clients' money into a market for next 3 years, where you think downside could be 10-15%, but the upside would be definitely much more than the underlying risk or volatility, which would be a favorite market for a 3-year time frame, where you think that early double-digit returns is something which is entirely conceivable and is realistic?
I wish there was one that just popped in my head right away, but I can't think of any where I would foresee double-digit growth in capital returns over the next 3 years. I think that's a bit of a tall order, actually, because I do think that we will be facing a U.S. recession probably within the next 2 years, and I do think that Europe remains challenged, and et cetera, et cetera. So I don't know if there's any I could see 3 consecutive years of double-digit growth. But I still think that, how should I say, that the U.S. market, because it's so big, it's a $30 trillion market, there's so much to pick and choose inside it that it has lots of good opportunities. And we find some in the healthcare sector and the industrial sector. So that's probably where I would focus my attention more.
Okay, fair enough. Mark, if I may get your view as well with respect to what's going on within the metals universe back home, largely connected with the kind of global volatility that we're seeing in metal prices, a fairly cyclical sector. Some would argue that one would find it very difficult to really play this sector as a whole. Where do you stand when it comes to metals?
On the industrial metals, we don't really like any. We think the market is in balance. There has been some supply disruption coming out of Brazil and I think Australia in iron ore. But on the other hand, there seems to be a bit of a global slowdown going on. So we think there's a balance there. Precious metals are more interesting, though, and it's one of the few places in commodities where we do have a bullish view on gold. And I think we think gold should be about 15% higher over the next year. The basic reason is that we do think eventually the U.S. dollar is going to stop going up. It should probably stop going up around now. And that has been a major thing holding it back. But at the same time, with all these trade wars and confrontations between the major powers of the world, Russia, China, the United States, and there is a case for diversification away from dollars, and the central banks are doing that. And one of the things they're diversifying into is gold. So that's what I would say. We like gold in the commodity space.
Okay, good to hear that, Mark, and always great to have you on the show. Thank you so much for taking the time out.